Our next guest foresees heightened likelihood of a global recession as the two largest consumers of crude oil, U.S. and China, remain locked in a tariff dispute. Joining us now from New York to talk about it further is Rob Thummel, Senior Portfolio Manager at Tortoise. Rob, thanks a lot for joining us. Investors who are long oil, and in particular long the share price, long the stocks of companies that produce oil, are watching these movements through their fingers these days. Is there any sign of a bottom in sight?
Well, yeah, that's a good question, Paul, and thanks for having me on. Well, we do know that eventually oil prices will stop falling, although in periods like this, it seems like they never do, but eventually that they do. We're getting down to the level where, obviously there will likely be some supply cuts, I guess, to help balance the oversupplied market right now. We just had a flurry of activity actually just over the last few days where the market became really oversupplied by an increase in the supply by OPEC plus, offset by obviously all this uncertainty and concerns about demand, as you highlight. Now, hey, the good news is for all consumers in Canada and the U.S., gasoline prices are probably going to be much lower, and so that's always a positive. And that these low prices obviously drive demand higher, and that helps balance out the global market as well, and will help oil prices likely improve over the next several months.
A lot of people are confounded that OPEC Plus would choose this moment to declare that production quotas will rise. Do you see any possibility of OPEC Plus reversing course?
Well, they always have the ability to do that. And they made that clear in the press release that they'll reassess the market in May and revisit their decision. There's some inner workings inside of OPEC Plus, I think, that were really also responsible for the rise. There are some countries that are overproducing what they're supposed to be under the agreement that all of the collective countries agreed to. And so if those countries actually come back in line and produce what they're supposed to, then the actual physical supply added to the oil market won't be quite as significant as what's being reported as the physical increase. And so that will help balance the markets as well.
A lot of people are wondering, and we keep asking people like you, how all of this looks to the U.S. administration and whether the U.S. administration may reverse course when it sees damage to the U.S. economy. Consumers, we just asked our most recent guest, consumers paying higher prices for goods that they purchase that are manufactured in China. But one of the takeaways here is that U.S. gasoline prices will decline, correct? And that is something that the White House would likely welcome, as would any incumbent politician.
Yeah, you're exactly right, Paul, and that is the one positive here that I can see so far is we're going to see much lower gasoline prices, and that is a positive for the American consumer. That puts more discretionary income back into the pockets of everyone, and so that is a good thing. What we do think is you probably need to see oil prices a little bit higher, probably in the 60s. To be kind of that Goldilocks scenario where the oil and gas producers in the U.S. can earn adequate returns for investors, and the U.S. consumer can also obviously experience those low levels of gasoline prices and diesel prices. So that's probably where we'll end up eventually. And it's obviously not going to be straight line to get there, but that's where we see it going.
What about the U.S. oil producers, the shale producers in particular, who have become regarded in recent years as being important swing producers in the market? Is $57 crude oil profitable for the U.S. producers?
It's profitable, no doubt about that. And I also have to remind your viewers, and a lot of them know this, is the U.S. oil and gas industry has made significant strides in improving their balance sheets. And, the last time we went through these lower oil prices, there was lots of concerns about bankruptcies and things along those lines. Now, in today's environment, much better environment. The balance sheets are fixed. They're much lower levered. These companies are generating free cash flow. So that's the more important point is where do the companies stop generating free cash flow? And that's probably somewhere in the $50 to $55 WTI range. And so it's going to be really interesting. And we're going to watch very closely in these first quarter conference calls as to what the producers are saying in the U.S. in terms of their drilling plans for the remainder of the year, given this fall in oil prices. I would suspect if prices stay where they are for a 2 or 3 month period, you will see a decline in drilling capital expenditures throughout the year. And then that'll obviously result in lower production growth out of the U.S.
So we've had a good conversation. At the end of the conversation, have you changed your year-end target on West Texas Intermediate crude pricing?
Yeah, I think, we've always had a wide range, I guess I would say, for our view of what West Texas WTI was going to trade at during the year. I guess what I would say about that, we're probably more closer to the lower end now of the expectation than maybe the midpoint of what we're expecting. So right around that $60 range, 60 to 65 is probably the good average for the year, is where we would expect it to be.
Rob, thank you very much for this conversation.